Good morning, friends. It's Steven Woloszyk from Prime Lending. Today is Tuesday. It's August 2nd. That means it's time for Tuesday's 2-minute tip. Last week, I mentioned about a gentleman who asked a question about borrowing from his 401k to get to a 20% down payment level. Why? He wanted to avoid mortgage insurance. I was not a fan of it. I was not a fan for a number of reasons, including taking money out of the market, but also in the different options there is to be able to structure mortgage insurance. So, mortgage insurance, what is it? Mortgage insurance is required whenever you don't have a 20% down payment on a conventional loan. The amount of mortgage insurance is dependent upon how much you put down. So the more money down, the less mortgage insurance. But the key thing is there's a lot of different ways to structure mortgage insurance. 1, you can take mortgage insurance on a monthly basis. 2, you can have a single premium payout whereby you pay all of the mortgage insurance right up front and it's not a part of your monthly payment at all. 3, you can have lender-paid mortgage insurance, whereby the interest rate is bumped and the mortgage insurance is paid by the lender up front. And 4, there's also a split premium mortgage insurance, where you pay a portion of it up front and then a lesser amount on a monthly basis. The key driver when it comes to mortgage insurance is a combination of how much you're putting down, but also the credit score and other risk factors. The higher the credit score, the lower the premium, and vice versa, which is why I started the videos in the first place, because it's just hugely important. The higher the credit, the less you're going to pay in interest and cost over the life of a loan. Realtor called me. He wanted an estimate on a purchase at $175 over the weekend. When I ran the numbers, assuming mortgage insurance, credit score of 760 or above, the mortgage insurance was only $50 a month. Turns out the gentleman had a lower credit score, and the mortgage insurance wound up being closer to $200 a month. On the single premium payout, initially it was $3,000. With the lower credit score, it was over $7,000. So it's hugely important, again, to have the highest credit score possible. But mortgage insurance can be structured in a number of different ways. The key point is you do not need to have 20% down to purchase a home. You do not need to borrow from a 401k to get to the 20% level. You need to call your lender and discuss the different options that are available for mortgage insurance. Steven Woloszyk for Prime Lending. I thank you as always for tuning in, hitting like, comment, and sharing. And as always, make it a great day.